So guys, welcome to another episode of the Goodegg Live Masterclass. Today we have our very own Maggie Vineyard on to help us understand the landscape of the real estate market. And, I'll hop on, towards the end to kind of, fill in some of the gaps of some of the cool things that we're doing here at Goodegg. But if you haven't joined us on one of these episodes before, I'll go over the agenda really quickly of what we're going to cover, but I really more want to impart why we do this for you guys. Today, we're going to tackle the markets, like kind of where the best buys are for multifamily real estate. Also, what kind of returns you can expect to see on conservative investments, moving forward here in 2021, and then how you can actually diversify your portfolio and still maintain capital preservation, cash flow, and appreciation. But like I said, if you have not joined us on one of these, episodes before, we do this series, for you to kind of get you up and running with syndications and funds. Maybe you've thought about investing in syndications and funds before and got cold feet, or maybe you've actually invested in one before and you're like, uh-oh, I made a mistake. Guilty, I've done that. Or maybe you're just hearing about, syndications and real estate funds and are confused on just where to start. That's what we do. We come on here live every single week to kind of help demystify this whole process for you, give you a forum to ask questions, and pair you with experts that can help kind of fill in the gaps for you. But we here at Goodegg, we invest in real estate because it gives us financial independence and financial freedom. Really helps us, give us control of our time. For me, if you guys, I've met several of you guys on here today. I got started in 2002, living, flipping, and house hacking. And, I had large chunks of money, built up, but it took me a few years to realize I didn't have cash flow. I didn't have that steady, cash flow, that I could rely on coming in from like rents to actually help offset my income and kind of help me break those shackles of like a paycheck dependence. Anyways, fast forward here, my husband and I, we spent a considerable amount of time building our portfolio. And then, we had to hit a level of scale when he wanted to step away from his job too. And that's where we started diving into multifamily. And here, fast forward with Goodegg, about 3 years later, we've invested in over 26 multifamily deals, 6,000 multifamily units under management. You guys, I never talk about self-storage and mobile home park. We have two self-storage investments and a mobile home park investment. So this is not, out of the realm of possibility for us to dive back into those areas. But more importantly, we have, the expertise, and I'm going to highlight here Maggie here in a second, but we have an $800 million portfolio under management. But what I get to do every single day is the director of investor relations and work with you guys, help you guys get comfortable with this, this wild world of real estate investing, and, help you build and scale your portfolios. So, but before we dive into today's topic on the state of the union, what an appropriate day for this. I mean, you guys know that I guess the first State of the Union of the new administration's tonight. So, just kind of funny timing, I guess. But anyways, I want to introduce Maggie Vineyard. She was on a few weeks ago, and I was like, man, we got to bring her back. Like, we got to highlight the brains and the brawn behind our underwriting and everything. So Maggie, take a minute to introduce yourself.
Hi everyone, thanks Whitney. My name is Maggie Vineyard and I handle underwriting and acquisitions for Goodegg. Came on about 6 months ago, so it's been a great transition so far, and I'm excited to be here.
Awesome. Well, cool. Yeah. You want to just tap in a little bit more of like your background and kind of what makes you an expert in all this?
Sure, absolutely. So I was a multifamily mortgage broker for approximately 10 years. Started out as an analyst, really learned the nuts and bolts of underwriting, evaluating financials. I've looked at hundreds of multifamily properties, rent rolls, expenses, and really across the nation. So I learned a lot during that time, and bringing that knowledge and expertise on the financing side, and it's a good fit for Goodegg. I've also developed a wide range of contacts and networks through that tenure in the mortgage business. So I've got great contacts, brokers, owners, property managers all over the place. So yeah, it's been really fun now to get on the acquisition side.
Awesome. Yeah, real estate is such a relationship business. I mean, it really is like your network is your net worth. Like, especially, I can't say it any, I think it applies to anyone in any stage of life, in any industry, but definitely here in real estate. So we're very thankful to have Maggie on board. So Maggie, let's open up. Where are we today, like compared to like 6 and 12 months ago?
Yeah, it's been such an interesting year, as everybody knows. I mean, as we all know, COVID was kind of came out of left field last year, and it really came on. I believe that was in February, March, right around prime leasing time in multifamily, which is usually in the spring, right before summer hits. And so I think the U.S. vacancy rate nationwide hit a high. It was the highest it's been in, I believe, 20 plus years. But the cool thing to note is that everyone was really scared, like, how is this going to affect the multifamily industry? And I think it almost just showed how resilient multifamily is. Even in downturns, people need a place to live. And so by June of 2020, the leasing velocity, things were already back to normal. And I think it just shows, the strength of this asset, not only during COVID, but in 2007, multifamily rents declined the least of any of the real estate asset classes. And they also recovered the quickest. So again, people need a place to live. We've seen kind of the fallout in retail and office, which is scary. And luckily with multifamily, we haven't really seen that. So that's great. You did see people losing their jobs, mostly in the retail sector. So I would say in terms of our portfolio, we may have had, a bit of non-payment in our Class C properties, but we were able to work with our tenants and help them get the resources they need. Luckily, there is rent assistance federally as well as locally. So we really did not see the fallout. And a majority of our portfolio is Class A and B, and really hardly any fallout there. And I think that's just the nature of the tenants' employment. So yeah, so I would say, we've kind of made it through that, and we're seeing things kind of ramp back up again. And so, thank goodness it wasn't the massacre that we were all thinking it might be. So yeah.
Yeah. I mean, I like talking about, there's a real opportunity to, when you have like disruptions like this, to get extremely creative. And that's when I think, and I drive this home with every investor I talk to. It's not the deal, it's the operator. What kind of depth does that operator have to adjust the business plan to the environment? And one of our stories we had a little bit of occupancy, elevate one of our properties because there was this huge student base. They wanted, not huge, I think like 10% student. And at the end of last year, everybody wanted to go home. Like nobody wanted to stay on campus, right? Everybody was like, nope, I'm going home. We saw that as an opportunity to take our 3-year plan to turn the property and do it in 3 months. That is the type of operator that you want to be with. Somebody who sees, can make lemons out of lemonade, sees the opportunity and what's happening around them. So I'm really glad that you touched on that. So if the multifamily market has kind of returned to normal and is fairly stable, like, what are we seeing today?
I think the biggest difference that we've really seen is the out migration from, these gateway cities that used to be kind of the center of the universe in terms of employment. New York, San Francisco, Los Angeles. People have really, being able to work from anywhere has opened the door, and people now are realizing, I don't need to pay these crazy rents to live in New York City. I can work from anywhere. I want that quality of life. I want to be able to walk outside my door and, enjoy nature. So we have seen a huge shift away from primary cities and to these suburban markets. And that's great for us. I mean, we've been able to capture a lot of that migration. As you know, a lot of our assets are in Texas, as well as the Carolinas, and there's a huge migration to those particular states, not only for the space and the affordability, but Texas, you've got no state income tax, so we've been able to capture that, and I think that's great. And other than that, we're sticking to our same underwriting guidelines. We're still being as conservative as we can in terms of mitigating risk. Watching where interest rates are, accounting for just the age of the property over the term, looking at the exit cap rate. So yeah, I would say we're in a great position moving forward. The financing is a big piece. And as I'm sure everybody knows, it's a great time to refi your home. And so that's also had a large effect on the multifamily industry, because I think, not long ago, you could actually get multifamily interest rates lower than single family, which is very unusual. But that has also had a huge effect on people's power to buy and to leverage this cheap money and buy even bigger properties. So it's gotten really competitive out there. In fact, we were bidding on a deal in North Carolina last week, and it was a large deal. I mean, $45+ million. And I think the broker had 19 offers, which is, unheard of. And this was not a large city. This is kind of a secondary, even tertiary market. So it's become really competitive. And because of that, people are paying high prices, and we've got to be even more cognizant of, the price you can pay. At some point, does it still make sense? And are we still going to be able to pay our investors that return that they're looking for? And that's one of the biggest shifts, I think, even from 6 months ago. The return you're going to get on a Class A, brand new property, your cash on cash return might be between 6 and 8%. It's not even, it's not where we were even 6 months ago. You're looking at an IRR, 10 to 13. And this is for like a stabilized brand new Class A product, which if your main goal is to preserve capital, and then that's a good fit for you. If you are looking for cash flow, you may want to start considering more Class B, Class C properties. That's where you're still going to get that cash flow. But then again, it's a little bit riskier just in terms of, the asset class. That's why it's so important, again, the team you've got on board, right? And we've spent a lot of time not only out looking for properties, but vetting other partners and operators, and so that's exciting. We've got some deals hopefully coming up with some new operators that we recently have been building a relationship with, and who are kind of experts in their field. So I'm excited to bring that online hopefully soon.
Awesome. Well, hey, let's back it up a little bit. I think, we started talking about asset class, and, I definitely want to dive in a little bit further on that, because, what I see there is the opportunity for, investors to diversify their portfolio, because, we've been hitting, the Class B value add deal has been kind of like our bread and butter, so a lot of our investors are very heavy in that. So I see the opportunity to diversify, but I want to stick a pin in that and come back to it, because I think it's very important for us to elaborate on that diversification piece. But for right now, can you dive in a little bit more about the interest rate, how that's affecting deals and the risk that investors might not see that are in some of these deals today?
Absolutely. I think the biggest change we're seeing is people are using bridge financing quite a bit right now. And typically a bridge loan, you can think of it as a construction loan almost. It helps you not only finance the purchase, but you can include any improvements that you're making to the property, and the bank will also fund part of that. And traditionally in the past, bridge loans were about 1% higher on interest rate than a traditional agency loan. But we've really seen that rate compress. And in fact, there may be a quarter to a half% higher. And so getting, if the rate is comparable to long-term financing, but it allows you to get greater leverage and even finance part of your renovation costs, that's really attractive because, if it's a pie, you're buying a pie, if you're allowed to use financing at 3% or 3.5% to get more of the pie, all the better, right? And so bridge financing has become really popular. It also is typically an interest only period for 3 years. And so when you are taking units out to renovate and turn them over, it gives you, it allows you to more easily take those units offline, be able to renovate them. You're not getting rent on those, but you can do your renovations and still easily make, your payments on the loan. The thing you need to be careful with the bridge loans, they are short-term loans. They're typically 3-year loans with 2 12-month extensions. And so I think it's important for investors to know if the deal you're going into is a bridge loan, and to make sure that operator has a plan in place to either refinance or sell at the end of the term. They can often get that extension, but you want to know they've looked at all scenarios in that case. So we are definitely looking at using bridge financing on some deals that we've got. Certainly. Yeah.
So just to sum that back, it sounds like bridge financing has its time and place, but there might be some misuse of bridge financing, and that's something to watch out for. Would it be fair to say if you have your stabilized A-class property, you're holding on 7 to 10 years, putting in a bridge loan for 3 might be?
The difference is really in the leverage. If you need leverage, traditionally with bridge financing, you might be able to get 75 or 80% LTV. And a lot of agency debt, you're at 65, 70. So I would just say, is there some kind of value add component? Is there some reason that, because the bridge lender will want to know what are you doing to increase the value on this property, and why do you need bridge financing? That brings up a good point. A lot of the Class A properties we're looking at came online, they're brand new construction. They came online last year during COVID. And I think developers were so nervous that they literally just wanted to put heads in beds, right? So they were actually giving pretty big discounts in terms of rent compared to what the market was. And so we've seen some good opportunity with that. Typically you think a brand new property, what's the value add? But if it came online last year during COVID, we're seeing, some of the rents were leased up $100 to $200 under market. And so that's been a really interesting opportunity and great for us, because it's all about the operating inefficiencies and then just bringing those rents to market. And we don't have to take on any risk of renovating units. So that's one asset class that we're focused on, looking for brand new construction properties that just came online and perhaps were leased up under market. And then, a developer is not in the business of typically running a building. So usually there's quite a few operational inefficiencies, just expenses that were really high that we can stabilize. So that's kind of a piece we're looking at now. But then to your point about diversification, we're also seeing a lot of opportunity back to our roots in the, B-, C-class assets. And it's really important to know what your goals are. So if you are, you're closer to retirement, you really don't want to take on a lot of risk, you want to preserve your capital, then this Class A type asset might be perfect for you. But let's say you're younger and you're anxious to get some cash on cash, and you want to just really be able to hit it out of the park and see a big return on your investment, then you might be willing to take a bit more risk on and go with a class C or B project. But then again, it's all about the operator. And so I think that's where we can bring a lot of value, is we really vet these partners and operators stringently. And there's a lot of operators out there that I'm seeing that are doing crazy things. So I think just really knowing who you're working with, diving into their underwriting. If you have questions or something doesn't make sense to you, bring it up, because there's some inexperienced syndicators out there that I've seen that are overpaying, and they're not necessarily accounting for the risk that they might have upon sale, especially interest rate risk. I mean, interest rates are so great right now. Will they be higher in 5 years? I can't imagine they won't be, just because they're so low. It's like, how much lower can we go? So I think that's really important.
That's a great, I don't want to say like red flag or warning, but a great kind of training piece, because, investors, when you get into investing passively, you're really putting your faith and trust in the operator that they are, able to run a business, that they are looking at all these different pieces, that they're underwriting the market, they're underwriting the deal very stringently. And so you have to, that trust is the foundation, right? And so, I always encourage people to ask questions, right? Like, if you're going in a deal, don't take it at face value. Like, ask questions, make sure you understand. So
yeah, and they should be willing to share their underwriting. There's no secret to it. There's no secret sauce that someone's doing that we're not doing, and they should be able to share their underwriting with you. You should be able to ask as many questions as you want, and really get that comfort level. I think that's ultra important for investors to really understand what they're getting into. And just because someone's been doing it a long time, or they're a large group, doesn't mean you shouldn't be just as diligent in reviewing their numbers.
Yeah, definitely. And, just note for investors, this is kind of like, a little training piece. Like, if, asking for a wealth of like underwriting can be a little bit of a wieldy project, but like, if you're going to go in on a deal, if you're committing to the deal, Maggie's right. That is something that you can definitely ask for. There's generally like a confidentiality around it, if there's multiple deals going on, but yeah, that is definitely something you can ask for. I want to kind of switch gears, because, you touched on this, and I want to dive a little bit further. If markets is one of the opportunities in the shift in the markets and where people are moving, like, what markets are poised for 2021 growth right now? Like, where are we looking?
Well, absolutely. Texas, which is where I am. I'm in Austin. And so Dallas, I mean, Texas is just booming. It continues to boom. Everybody has seen Elon Musk, has moved here. There's all kinds of people moving here, and it's such a great landscape for businesses. And just because of there's no state income tax, right? Also, this is a great kind of map, and it's exactly where we've been focusing our attention. Also, the Carolinas, they're seeing a ton of growth. So we've been heavily focused there. We do have assets in Florida. We're not currently looking at Florida, but it's also has a ton of population growth. And the one I'm kind of most excited about is Arizona. I know we recently polled our investors, and there's a large appetite for Arizona. And so we've been vetting some partners there. I'm actually going to fly out and meet some of them in a couple weeks. And I think we'll have some projects there fairly soon. So I'm excited to get more involved in Arizona.
Awesome. Yeah. Most of the people here know, but my husband and I, our family, we spent the month in Arizona, got out of Colorado, like, for the winter time. And I was,
so nice.
It was awesome. I was very impressed with the area, like, Phoenix and stuff like that. I totally see why people are moving there. So I kind of, want to wrap us up and leave a little bit of room for questions and also share some additional information. So, first of all, I just want to thank you for kind of, putting some color to what we're all feeling that's happening in the market.
Mhm.
And, to sound all of this back to you in just kind of like some small nutshells is that, perhaps, the investors here can expect to see assets that are going to help them diversify their portfolio.
Absolutely.
Whether it's if you're looking more at capital preservation with a little bit of cash flow, class A, right?
Mhm.
If you're
Mhm.
looking, we're still going to look for those class B multifamilies, value add multifamilies, those BB pluses, but that's
Mhm.
really where the heat is right now. So
Oh, it's so competitive in that space right now. So we're certainly still looking at it, but yeah, we've seen some opportunity in class A that hasn't been there in the past. So you can't expect the same returns that you were getting even 6 months ago. And so I
that's
think
for
just
anybody.
setting those expectations, and being realistic, you're not going to see, 10% returns on a class A project. But you're mitigating a lot of risk, right? And so just having a good handle on what goals you have, but like you mentioned, diversifying. So maybe you've put some money into a class A project and now you can look at C and kind of diversifying. But I think you've, Whitney, got some exciting news and how we're going to help our investors diversify and kind of make it easier for them to do it all in one space and not have to go vet different asset classes and different operators. So I don't know if you want to touch on that, but
Well, thank you. Yeah, no, I'm super excited. I mean, several of our investors have kind of like gone, she's mentioned funds a few times. It's been, you've seen self-storage and mobile home parks in our newsletters. And that's what I've been working on is, how can we diversify, help investors easily invest in other asset classes outside of multifamily real estate. And, it's a different vehicle. It's not something to replace the single asset entity that, they're accustomed to doing with us with multifamily. This is going to be a fund where we're pooling several different investments together in the self-storage and mobile home park space to, and this investment's really great for somebody who wants to, invest a chunk of money and have it broken out over multiple assets, multiple geographies. Also, the risk profile of mobile home parks and self-storage is different than multifamily, and we're going to do future episodes and really kind of dive into that. What is the risk profile here? How does it differ? It has a different expense ratio, different tendencies. I always struggle with that word. I don't know why. But you guys are picking up when I'm laying down. But yeah, so that is something we're getting super close to launching it. I know. I'm going to get a email box flooded with like questions on the returns and numbers. Can't share that yet, but we're getting super close. So I'm super excited about that. And, it won't be just one fund and done. That is something that we're looking strategically as a business. How can we continue to add different investment vehicles for people so they can, again, like you said, Maggie, they've landed with Goodegg, they know, love, and trust us. How can they actually continue to grow and diversify their portfolio in one spot?
Right.
Yeah.
Awesome.
Well, hey guys, I invite you guys to answer questions. Just pop on over to the chat box. This has been amazing. If you have to drop and you're just here for the information portion, definitely feel free to do that. We will continue our conversation around mobile home parks and self-storage next week here on the Goodegg Live Masterclass. If not, jump on over to the chat box and let us know what questions you got.
One thing someone recently asked me is kind of what kind of challenges do I see going forward? And I think some things, people are still concerned about are just COVID, but luckily with the vaccine distribution, we're really seeing kind of that anxiousness go away. So I think it'll continue people will be traveling again, and that COVID, that nervousness will kind of dissipate. Tax law changes, that's a big one that we don't know what's going to happen. So And then, kind of it's become such a global economy. So sourcing materials and operations around the globe.
Yeah, definitely. But those are all the things that we're looking at and mitigating the risk,
Right.
in our portfolio before we even put that deal out to our investors. So I'm
Mhm.
very much like, everybody should always feel empowered to do their own due diligence, but that's what makes our group so wonderful, and that's the reason why I joined Goodegg, a few years ago, is because we were
Mhm.
taking that careful care to really
Mhm.
look at the assets, because we know people are busy. We know this is not their area of
I
expertise.
know.
But
Yeah.
I'm all about empowerment. So, and that's why we do this Goodegg Live Masterclass, is so people can learn in small chunks, like, about the state of the market. Where are they going to get all of this, this data that you just talked about and shared? Um,
Yeah.
it would be
Yeah.
really hard for them to kind of piece that together on their own.
Yeah. It's
But
time consuming. Absolutely.
yeah. Well, hey guys, if you got questions, pop on over to the chat box. If not, thank you so much for spending your most valuable asset, which is your time here with us today. And we will talk to you soon.